the key is here, we need a system where you can be average and still win. And so I think about my portfolio as basically dollar cost averaging every 18 months in real estate. Sometimes I will buy high at the wrong point in the cycle, and sometimes I'll buy low. And it's really hard to know that. And everyone wants to predict the market cycle in that context. But I think first and foremost, I believe in that long-term thesis, and I'm going to buy consistently when my position can afford it. I'm never going to put myself in a position where I'm dependent on the property working out to move my financial position forward.
I wanted to start off, you're CEO of BiggerPockets now, but it always wasn't that way. You kind of started as a cubicle guy, working at a company. I think it was like the worst rated company, of all time or something. I forget the Glassdoor rating was not very good. So I wanted to hear about those early days of yours, just like working, you come out of college, you're working this cubicle job. Talk to me a little bit about that and just how the search and interest and hunt for financial independence got started for you.
Yeah, sure. So in 2012, I was between my junior and senior year of college, and I got an internship at a Fortune 500 company here in the Denver, Colorado area. And the internship was wonderful. I had a great time with my friends. I made a bunch of friends, got a job offer, and then decided to accept it and had my job lined up for my entire senior year of college, basically, and moved out and started that job in 2013 in the late summer. And within a couple of months, I realized that while the internship was great, and while make a big deal about the worst company rated in America, it was at the time I worked there. That was a true story. But I wasn't mistreated or anything. I had good colleagues. I
Right.
had good, reasonable work, reasonable pay, all that kind of stuff. I just realized that there was no long term upside for me in the way that I wanted to advance my career. It would take 20 years to move into the C-suite if I was very fortunate and lucky,
Mhm.
and had a number of really good moves. And I had, I was ambitious, and I was starting to catch the bug for this concept called financial independence, retire early. Probably a couple months into that journey, I was studying how to be a better financial analyst. I'm putting myself back 12 years. I think I was studying to become a better financial analyst, how to be, learning about finance, and the concept of personal finance came up, and that led eventually to, I think, the Mad Scientist,
Yeah.
to Mr. Money Mustache, who was really the big influence on me. And the aha moment came while diving deeply into his content. So once I got the bug for financial independence in late 2013, early 2014, a series of cascading events led to me joining BiggerPockets. I started listening to the BiggerPockets podcast. I started meeting up with a group of local real estate experts and entrepreneurs. And I took each of them out to lunch because I was lucky to be a part of that group. I kind of happened upon it serendipitously. One of them happened to work in the same co-working space as the founder of BiggerPockets, Josh Dorkin. I was a big fan personally of Josh and more broadly of the BiggerPockets business. And so I said hi, bugged him a couple of times, and eventually got an interview, and became the third employee, the director of operations at BiggerPockets. Now, there are other people that were technically working there. I was the third full-time employee at BiggerPockets that was actually employed by the company, not a contractor.
So what was that move like? Like moving from a traditional finance company doing analytics and moving towards a much more entrepreneurial kind of startup. I think BiggerPockets had been around for quite a while at that time, but still it was early days. And like you said, you were the third employee. What was that move like? And how did you think about it? Was it a risky thing for you at the time?
Yeah, so risk in my mind had to do a lot to do with my cash position, and because I was so frugal, thank you, Mr. Money Mustache,
Mhm.
I had amassed, probably by the time I joined BiggerPockets, like $15,000, and by the time I bought my first property, $20,000 to $25,000. I joined BiggerPockets in July 2014
Mhm.
and went under contract on my first duplex shortly thereafter. Um, and my comp was essentially flat between the two companies. My benefits, if anything, were a little worse at BiggerPockets to
Mhm.
start, small early days. But what was life changing and so awesome about BiggerPockets was, one, the passion I had for the mission. I was a huge fan of the
Mhm.
company. It was changing my life
Yep.
in real time when I joined, and the ability to just constantly learn. My days were completely filled with me learning and developing new skill sets. It was expected that I learn how to, I read this blog, learn how to run a split test, two
Mhm.
different experiences on the website,
Yep.
and see which one gets better engagement, for example, and then go and implement it, in, the next day or two. That was like, those would be like regularly given tasks for me. Go figure out this billing platform. And I just thrived in that type of environment. That's where I do best, is constant learning. No 2 days are
Yeah.
the same. There's always a new challenge.
So your initial role was what? Director of VP of operations?
Yeah, direct. I had a string of operations titles over my time at BiggerPockets, but yes, it started as director of operations, which at a three-person company means everything from you do revenue to get the coffee, please.
Right.
So move the car. Yeah,
Right. Right. And it sounded like you pestered Josh a couple times so before he finally was like, okay, we'll give you, we'll give you a chance here.
yeah. He remembers it differently, but
He
I
does.
seem to remember having to follow up a number of times and interpreting his reaction as me annoying him in the middle of his workday
Yeah.
when I said hello.
I wanted to get into you mentioned your first deal. Talk to me a little bit about that. You had an interview a few years ago with my former co-host Robert Leonard. He wrote a book on house hacking. So I wanted to hear, is that talk to me about the first deal and if that was part of it, was doing a house hack on it.
Yeah, the first deal was a duplex. It was in Northeast Denver, $240,000 purchase price, 5% down, $12,000 down payment. The mortgage was 1550, including principal, interest, taxes, and insurance. Um, Other side paid 1150. I had a roommate paying 550. So, it was right there on, and this was not lavish living, right? This is a box, right? 700 square foot each side,
Right.
flat roof, yard is a disaster. Worst house in the block kind of purchase. I bought it from HUD, which was a huge advantage because at the time HUD was offering it only to people who wanted to own or occupant. You had an exclusive window for 30 days. And at the time, house hacking was not super popular as a term.
Mhm.
Um, so I was not competing against the investors who might have otherwise bought it. And I had some time to just think and react to it. I got to run it by one of the people in that mastermind, for example, and he was like, dude, yeah, you gotta go on this one. If you don't, I'm probably gonna be making
Right.
offers on this in a few weeks. And like those little things, that network, those connections make all the difference in helping get you over the hump, because it's terrifying, right? I mean, if someone going through their first purchase today, relatively speaking, you might have a similar, challenge, right? I was making 50 grand,
Mhm.
and that property was $240,000. Right? I mean, I don't know, but if you're looking at something that's 5 times your annual income, then it's perhaps a similar type of dynamic.
Yeah. So let's get into the book a little bit. Set for Life. That was a big influence on just the way I think about money and finances. Talk to us a little bit about it for our listeners that aren't familiar with it. It came out what in 2015? Is that about right?
Yep.
Yeah. So it's
Uh,
I'm sorry, 17.
I think, yeah, something like, it was somewhere in that, yeah, that range. I think it
Yeah.
was 2017.
I mean, I mentioned this before we got started, but I'll see a lot of lists on like the best personal finance books that people should read, and it's consistently listed. So share with us, like, what is it you think? I want to hear a little bit about the process of writing it, but first, I want to just hear about what is it you think it is that just strikes a chord in the average reader that makes it so important and influential.
What I thought at the time, and I definitely, yeah, I think still agree with, is that there was a lot of books written about wealth management, but they were from the perspective of somebody in their 40s, 50s, who had amassed a large amount of wealth
Mhm.
and felt that that kind of was the credibility factor for that. And I think that when, after interviewing a lot of people, what I found is when people go back to the beginnings of their story, it almost always begins with that scrappiness, the frugality, the hustle,
Mhm.
those types of mindset, and then I think it mellows the world view around money begins to mellow out in the years later, right? And at the time I wrote the book, I was probably I was what 5, 6 years into my personal finance journey. I had accumulated plus or minus about $1 million in net worth, and I still had, and I'll call it the obsession with financial independence and the grind mentality that I think, sometimes gets a bad rap. There's the, hustle porn, derogatory comments and all that kind of stuff. But I fully subscribed to that for a good 5 or 6 years. I recall days where I would wake up in my duplex, make breakfast while listening to an audiobook, bike the 5 miles to Bigger Pockets, work at Bigger Pockets, bike to rugby practice, come back home, write a little bit more, and like that would be my day with $0 spent, have a
Mhm.
little bit of fun, but really hustle, work, and try to accumulate. And I think that the book captures that mentality
Mhm.
unapologetically from the perspective of somebody who is right in it and right at the, right, uh, uh, right there on the cusp, if not just over the edge of financial freedom, and knows what it's like in that journey. I think that's what resonates with people is it's unapologetic. It's hey, if you want to get to this thing, you need to save half your income, and that means you're going to make drastically different choices about where you live, how you transport yourself, what you eat, and how you prepare that. You can have fun. You can still, put together a little bit of an entertainment budget, but if you want to get there, you have to make big changes, sacrifices, or get really creative on those big three expenses. And then you have to be completely unapologetically opportunistic with your career using those savings. You have to make radically different choices, like not putting your money into a 401k. A 401k is a great way to diversify your wealth to 10% long-term average returns. It's not a great way to get a shot at early financial freedom, and take your crack at entrepreneurship or a highly levered real estate investment strategy, for example, which are ways to get there. You have to be willing to take risk and to de-risk that approach with the extreme level, I will call it, of frugality. And I think that's what the book captures. And I'm reciting all this, and I'm like, I don't know if I could write that today, because I have mellowed out. I don't want to live the way I did 5, 6, 7 years ago. I'm glad I did because I paid a price and was able to amass a pile of assets, that now produce a tremendous amount of optionality in my life and the ability to live an upper middle class lifestyle on passive income alone. But I don't want to go through what I went through to get there. But I think that a lot of people do, and a lot of people, and if you are willing to do that, that's what I think Set for Life captures. Maybe that other books don't. And I'm proud of it, and a little cringed at it, if you can't tell from my diatribe here, right? There's a different Scott who wrote it. I'm super proud of that, Scott.
Yeah.
And I recognize that like that's the mentality that you have to have if you want to really have that shot at getting ahead here, at
Yeah.
least without starting some uber big business.
I had an interview last week, and the gentleman made the same point that contributing to a 401k is basically it's a bet against yourself. He's like, you shouldn't be when you're young, you should be taking bets on yourself. And to you can maybe earn 8, 9, 10% interest, but like it's really by putting that money into a 401k, it's really a bet against yourself, or
I
certainly
think
not
that's a
on yourself.
I think that's a super interesting point, and I think I completely agree with that. Like, if you're someone, like this is the Millennial Investing Podcast, surely a lot of people listening to this want to get ahead early in life.
Yeah.
And I think that if all of your wealth, I mean, this is the middle class trap, right? The middle class trap is I don't know how many millionaires we've interviewed on Bigger Pockets Money who, hey, I've $500,000 in my home equity, I've got $450,000 in my 401k and Roth, IRA combination of retirement accounts. I've got 25,000 in my after-tax brokerage, $15,000 in my checking and savings, and $7,500 in credit card debt. And it's like you're almost a millionaire, or you are over a millionaire, but you have no ability to leave your job. You'd be broke after a month or two. And I think that's right. I think that if more people took those first few years of savings and just amassed 50, 100, something like that outside of the 401k, especially early on, by making those sacrifices, paying the tax man, they reap the rewards from optionality to start businesses, buy real estate, all those other kinds of things. The key is though, you have to have the mindset of I'm going to use it to take my shot and make my bet, not buy a boat or a Tesla.
Right. Right. Yeah. Charlie Munger has that quote about like the first $100,000 is a, but being able to save that first 100,000 and then figuring out some different options probably makes a lot of sense for people.
Yeah, and I wonder, if he were here, if he wouldn't maybe amend that a little bit to say the first 100,000 after tax
Right.
is right.
Right.
With that's how you really begin to, or the first 100,000 that you really have that control over. The first 100,000 your home equity, happens automatically and doesn't give you that control.
Yeah. So in writing the book, we mentioned Mr. Money Mustache. Were there other influences on you that helped with your mental blueprints and how you were thinking about money at that time?
Yeah, I mean, I went down the rabbit hole of all the five folks. So there was the early retirement extreme guy,
Oh
Jacob
yeah,
Fisker. There was
that was
the
extreme.
mad
His
scientist.
stuff was extreme.
Yeah, I was like, okay, good. Like this, like his situation for me was super helpful because and complete respect for the guy. He
Oh
he
yeah,
has a wonderful setup and has really figured out a lot of things and inspired a lot of people. But for me, it kind of normalized Mr. Money Mustache because I was
right.
like, oh no, he's the extreme guy. Mr. Money Mustache is the normal one,
Yeah,
and I'm the normal one here with all these things. So that was helpful in a variety of ways, not just the tactics and tips, but also in kind of contextualizing what was going on. BiggerPockets, obviously. The Mad Scientist was another one with Brandon, who he lives in Scotland. So yeah, a couple, and there are probably more that I'm forgetting here and that I touched on. But again, that was 10 years ago now. So
yeah. There's another one that was influential to me called, and this was way back. It was written maybe in the '90s, I think. "Your Money or Your Life" by
mhm.
Vicky, Robin, and Joe Dominguez were, and the big idea was like putting a value on your time, and it's kind of a common thing now. Naval Ravikant has that thing like put a value on your hourly wage, and if something is not worth your time, like pawn it off to somebody else or delegate it or outsource it. Um, but it really gave this idea in Your Money or Your Life about what your time is worth in terms of your life energy and putting a dollar value on that.
Yeah, I'll put Rich Dad Poor Dad and The Millionaire Next Door in there as
Yeah.
books that were highly influential as well.
Yeah, definitely inspirational. So so let's get into real estate in 2024. You and I both got into it, about the same time, it sounds like. For somebody that's listening to this in 2024, does real estate make sense in your mind to as a path to wealth, and are the opportunities still there? Because a lot of people can be listening at the news with interest rates and all kinds of things saying like, maybe now is not the time.
Yeah, so I'll actually start the discussion with the stock market, right? What is an investment in a U.S. stock market index fund? Well, it's basically a bet on the long term growth of the U.S. and improvement and efficiency gains in the U.S. economy, right? And I think that if you believe in that long term bet in growth in the U.S. economy, you're going to place your money in index funds, set it, and forget it for a very long period of time. An investment in U.S. residential real estate is a similar type of bet, right? You're betting on the overall growth of the U.S. wage growth, long term inflation. You're betting on, in particular, that region that you're investing in a property in, and you're betting that you will over time get the rewards of appreciation multiplied by leverage. Most investment properties is bought with leverage. So I fundamentally believe in that bet. My portfolio here in Denver, Colorado, is a set of properties, duplexes, triplexes, quadplexes. I may purchase single family rentals as well at some point. And I believe long term in the growth of the US economy. I believe in long term inflation being at a little over 2%. I believe that in Denver, Colorado specifically, we will see net inbound migration over a long period of time. And we will have supply constraints that constrict new development, mostly in the form of water. We have got plenty of land out here. We don't have a lot of water
Mhm.
here in Colorado. And so I believe that I will experience a greater than 3 to 4% long term appreciation rate on both prices and rents, and that's why I continue to invest, hold my properties, and intend to buy more over the long term. And I think that's fundamentally what investors have to believe if they're going to get into real estate investing in any sense. Now, there's a whole bunch of stuff in the near term that you can focus on that then make things harder or that force creativity or that make people have pause. I mean, transaction volume is down dramatically from a peak in 2021 for a reason, right? Both on the investor and homeowner front. So we can get into all that near term stuff, but I like to frame it with what is the long term bet here? Most people aren't buying a rental property and holding it for 2 years. They're holding it for 10 or 15. And if you believe that, That's the first starting point. If you don't, you shouldn't get into real estate.
Right. Okay. So assuming we've got a positive, optimistic view of where the US is going and that growth is going to continue, let's talk next. Like, is now a decent time with interest rates high, or should I've talked to a couple younger guys who they want to get involved in real estate, but they're thinking like, well, maybe I should wait a little longer. Maybe rates will come down or values will come down. Like maybe now's not the time to buy. I know this is kind of case specific, but what would you say to a younger person like who's got some savings ready to make an investment, but they're wondering if now's the time to jump?
I think that the right time to invest in a market is when your personal, when one, if you believe the long term thesis, and two, when your personal financial situation and life circumstances are conducive to it, right? The right time for me to invest in a $500,000 rental property is when I have $125,000 for the down payment, when I have another $10,000 to $15,000 for reserves, and when I have whatever else is going to come up from a planned rehab perspective, whether the portion that I'm not financing, I have the cash on hand to cover that. Because again, if I'm investing in US stock market, right, I'm going to basically dollar cost average every month and add in the surplus that I get from my paycheck or whatever it is and put it into the market on a continuous basis, right? We want to follow the same pattern long term because what we're trying to do here, what I'm trying to do at least as an investor is I want a system where I don't have to be exceptional
Mhm.
to win, right? That's the beauty of index fund investing and why half my portfolio is in index funds, right? Is I don't have to be exceptional. I'm getting a low fee, long-term average here, right? Now, in real estate, we want to pursue some of the inefficiencies, and we'll talk about a good deal later if you'd like and how to find that specifically. But we start with a system that is going to produce a great shot at that kind of 15% ROI, at least in the early years when we're fairly leveraged, because we're doing all this work. We're going to have to probably visit the property. We're going to have to take a look at it. There are fees that are associated with buying real estate. We want a premium over what we can get in the stock market, but um, the key is here we need a system where you can be average and still win. And so I think about my portfolio as basically dollar cost averaging every 18 months in real estate. Sometimes I will buy high at the wrong point in the cycle, and sometimes I'll buy low. And it's really hard to know that. And everyone wants to predict the market cycle in that context. But I think first and foremost, it's I believe in that long-term thesis, and I'm going to buy consistently when my position can afford it. I'm never going to put myself in a position where I'm dependent on the property working out to move my financial position forward. Right. So here are some examples of things that I think get people into trouble. A HELOC, right? I take a HELOC on my primary and I use it as the down payment on my investment property. Well, this creates huge problem, right? Because I'm financing that property. I'm maybe getting a couple $100s a month in cash flow, but I have to repay the HELOC plus interest. So I'm getting a $500 a month cash flow property, and I've used a $60,000 HELOC. If I'm paying it back over the next 5 years, that's $1,000 per month in principal before we get to the interest. And that property is going to suck cash out of my life over that time. So again, I think that the personal financial position is the most important thing. Now, in 2024 specifically, right now that I've couched all of that and saying, don't time the market, don't think about all these about first start with a plan where you can win in any market condition and trust the plan over the long term. Now I'll predict 2024, despite the fact that I said I'm saying not to do that, right? Okay, so what's going to happen here this year? First thing I always like to start with is supply. There are about 1.6 million units of housing stock currently under construction in this country. About 975, but that's a lot. That's close to the historic high, right? So on average, we form about 1 million households per year in this country. Last year, we formed about 230,000 households because in tougher economic times, people tend to group up or whatever, right? There's just lower household formation. This year, the pressure is going to be even higher on the supply front. We saw modest price gains last year, and we saw rent growth actually decline by just under 1%, which is a rare thing for the US economy. In 2024, I'm expecting rent growth to continue decline by a couple percentage points because on average, that the US is seeing a ton of new multifamily unit construction hitting the market, which is what competes with everybody for rents.
Yeah.
This is a disaster for the multifamily and apartment complex investing space. Those guys are getting crushed. They've seen a 20% to 30% likely decline in asset values from the peak in 2021. And I think they're in for more of a bloodbath in 2024 here. I'm going to release an article to BiggerPockets that will come out probably before this recording. That's 5,000 or 6,000 words describing this pain in great detail, and why I believe that that's the case. On the multifamily side. On the single family side, we have a a little bit higher than usual, but pretty close to the normal amount of currently under construction supply, about 600,000 homes. Now, these homes that are being built are geographically dispersed across the country, right? So the South and the West are seeing a disproportionate amount of this new construction. And the South and the West, in particular, are getting crushed right now from a multitude of factors. They have all this new supply. There's a huge bet on inbound migration, which I worry for folks in those areas is a little bit overplayed at this point in time, right? I think all the people who wanted to move out of California to Texas may have done so by now, and that belief that more is coming again could be a challenge. You've got huge taxes in those states in the property tax front, and a lot of valuations have soared in the last 2 years, and those are still catching up. So that's causing taxes to increase in there. And you've got insurance costs rising at crazy rates in both of those states, Texas and Florida in particular, but much of the South and parts of the West overall. So those are causing a lot of pain for operators right now. And I think that if I'm looking at investing in those regions, I'm being very cautious and doing my homework on the supply that's coming in at the very least, and then also checking that against the, do I have some really bullish projections? Because like markets like Phoenix, they got really bullish projections on income and inbound migration, for example. Those might be true, but there's also a supply dynamic, and they got a ton of supply coming in. So I'd be really careful and do my homework in those areas.
What if in 2024, you got a little bit better every day? When you're learning a new language with Babbel, that's exactly what you're doing. And if Babbel can help you start speaking a new language in just 3 weeks, imagine what you could do in a full year. Babbel's quick 10-minute lessons are designed by over 150 language experts to help you start speaking a new language in as little as 3 weeks. Babbel's tips and tools are approachable, accessible, rooted in real-life situations, and delivered with conversation-based teaching so you're ready to practice what you've learned in the real world. Thanks to Babbel, I can start having conversations and order my food in Spanish at local restaurants when the situation allows. It's no wonder they've sold over 10 million subscriptions, and that studies from Yale, Michigan State University, and others continue to prove that Babbel is better. Here's a special limited time deal for our listeners. Right now, get 55% off your Babbel subscription, but only for our listeners at babbel.com/WSB. Get 55% off at babbel.com/WSB. That's spelled BABBEL.com/WSB. Rules and restrictions may apply.
In the Northeast and the Midwest, you have much more muted dynamics from a supply standpoint, right? So you don't have anything special going on, or a ton of construction. And I don't think you're going to see a lot of, I don't think you're going to see much of a decline in rents. You may even see substantial increases in prices and rents in those areas because they're still more affordable than other parts of the country, and you don't have the supply dynamics. On the interest rate front, I think that the markets are crazy right now, and I'll probably be completely wrong, and you can play this next year and laugh at me about all of this stuff, of course. But I think that the markets are a little crazy right now. All right, on the interest rate front, what the most important interest rate in to real estate investors is the 10-year U.S. Treasury. The 10-year U.S. Treasury is hovering around 4% right now. That's important because it's lower than the overnight Treasury rate, right?
Mhm.
Which is about 5.25%, 5.3%. What this means, usually the 10-year is about 150 basis points higher than the
In a
overnight rate
typical yield curve, right?
in a typical yield curve. So what the market's saying is they expect a recession so deep and so bad that the Fed is going to cut rates by nine times to get it to about 2.5 to 3%. I think they're nuts. The Fed is not saying they're going to do that. Yes, the Fed screwed up in 2021 and let inflation get out of control. Since then, they've been the least bad central bank in the world. I love using the word least bad
Least
because
bad,
it
right?
offends the fewest people with that. That's a compliment to Jay Powell. I think he's handled this better. Like U.S. is alone among major world economies that is doing all right now, right? I mean, you can see everyone has an opinion about what all right is, but they're not seeing the devastation that a lot of people predicted. They're seeing asset values crater in the commercial real estate space, for example, but we're not seeing the wealth of the middle class America being eroded right now from those decisions. We're not seeing mass layoffs, and they've got a lot of room to run. I take them at their word when they say they're going to lower rates 3 times in 2024. I believe them. If they do that, after that, I think it's anybody's guess, right? And in your coin, you're flipping a coin. If you think if they're going to continue lowering them, keep them the same, or raise them. And I think from that point, that means that 10-year is going to climb, right? That 75 bips down puts your from 5.25 for the overnight rate, puts your overnight rate at 4.5. That puts your 10-year at 6 if the market stabilized from a long enough time perspective. And that's not crazy in the context of historical interest rates for this country, right? Despite what a lot of people listening to this will say. So I think that there's every possibility that happens. I don't think the 10-year will get to 6, but I think it will climb up and up and up and up, probably 100 basis points over the year. And that's going to continue to hammer your commercial real estate space. But despite all this talk about interest rates, it's not going to hamper your single family housing market nearly as much.
And why is that? Explain that. Yeah, explain that a little more if you would.
Yeah, the reason for that is that a 30-year mortgage is tightly correlated with a 10-year treasury, but it's not perfect. And there's a higher than usual. So usually there's about 180 bips. Actually, I'm not gonna do this because I don't have this one fresh right in front of me. There's usually a certain spread between 30-year mortgage rates and the 10-year treasury. Right now, that spread is higher than normal. I think it's by about 75 to 100 bips. I should have had this one ready. People listening, go take a look at this if you're interested. But I believe that as the 10-year rises, that spread will compress and mortgage rates will stay in the high 6s, low 7s throughout the year in 2024. So I think that is that puts there's reasonable chance that U.S. housing stock on average, again, regional differences are going to be the story. They were the story of 2023, and they will be the story of 2024. Some people will feel tons of pain, and some people will see their properties and rents soar, depending on where you are in the country. And I'm betting on the Northeast and the Midwest as potential places in 2024 for appreciation. I think that the Southeast and the West are in for some potential pain in 2024 from a rent and pricing standpoint.
So in states in particular, what states are you mean like Texas, California? When you say the areas that will experience pain, what states would those be?
I think big markets in Texas and Florida are going to be among the hardest hit. Austin, Texas, I think is in for continued challenges. I think Tampa, Florida. I think these big metros in Florida and Texas are the ones there. Now, I am going to commission a study here at BiggerPockets to see where that supply is hitting, because that's where I think you should be the most afraid if you're an investor. Supply is not your friend as a new investor, or as an investor in this country.
Yeah, let's go into a little bit about. I want to specifically talk about your buy box. So you mentioned every roughly 18 months you're making a purchase. Let's talk about like what your buy box looks like and how, for a new investor, like how they can think about and construct their own buy box to test out a hypothesis.
Yeah. So first of all, now again, that's 2024, right? So take that how you will as an investor. And despite the fact that I think Denver, Colorado is squarely in I'm not loving the prospects for 2024. I plan to buy another property here in Denver in the next year, probably in the later part of the year. But I know that despite my prediction, I could be dead wrong. I could be right about everything and wrong about something else that comes in. And I'll bet you this, that in 30 years, my investment made today in Denver, Colorado is going to perform better than the one in the Midwest 2024 Midwest is going to perform better,
Right.
but in the next 10 years, in the next 10 years, almost certainly, in the next 20 years, for sure, in my opinion, come back and see me in 20 years, and we'll debate it at that point. But I think that Denver is going to see that price appreciation, and Detroit, for example, may not. So anyways,
Right.
uh, that's the theory there. My buy box in Denver. I really like big, nice, luxury multifamily. Small, and so my favorite type of property is like a 4 or 5 bed duplex on each side, right?
Say more
I
about
like
that.
it.
Why is that you want a big duplex like that?
I believe that there's a rise in high income earning renters. I believe that those larger units offer the ability to diversify your strategies. So, for example, you can do a sober living home if you
Oh,
wanted, right?
mhm.
You could do a rent by the room strategy and produce a lot more cash flow. They're the type of units I want to live in. And I think that that's important, right? Is that I'm buying stuff that I and my family would live in. I literally live in one of these types of duplexes that I'm describing here, right now, here in Lakewood, with my wife and our 1-year-old baby and our cat. And it's wonderful. So I like that for a number of reasons. I also think that it's better cash flow potential. So this property, for example, would be valued at around $750 to $800,000. Each side would rent for just over $3,000. The mortgage on that would be about 4,500, and that gives you a pretty good shot at cash flow with a long-term traditional rental strategy. More if you want to get into one of those creative strategies. The price point is also high enough where I'm not competing with folks that are buying their first, their first house hack or
Mhm.
small investment property. So that's the kind of stuff that I particularly like and feel like there's a reasonable competitive edge, and then the kind of thing that I'll probably buy here in 2024.
So is that who you rent to? Is it like sober living homes and do you rent out rooms by the room? Or talk to me about that a little bit more. Like you mentioned that those strategies of why you like that. Is that how most of your portfolio looks?
So that's what I'm going to buy this year. Most of my
Okay.
portfolio looks like what I bought my very first duplex: 2 bed, 1 bath units, 1 bed, 1 bath units, up and coming areas,
Got it.
those types of things. So I did very well with that strategy for a long time, but it is a little bit more intensive from a management perspective, and I'm preferring the kind of B plus A neighborhood investing these days as an investor. I do have to put more cash down in order to purchase those. 25% on a $800,000 property is a significant chunk of cash, but I prefer that personally and believe it's the right approach for me today. My other units typically, again, are in up and coming areas, duplexes. I have two other duplexes in the Denver area, a triplex and a quadplex. The quadplex is 1 bed, 1 bath, and rents each unit for $1,000 a month. So a very different type of property than what I'm describing to you here.
In your focus.
And my tenants in the nice properties, they're actually 5 individuals that pulled together to rent the property on one lease. They've been great. They live next door to me. Always take care of the place. Quiet, nice neighbors. Help us out from time to time.
And you focus strictly in Denver. You wouldn't go to Detroit just because of the values or whatever the numbers might look attractive right now. Your long-term thesis is strictly Denver, correct?
Yeah, I may change that at some point in the future, but to this point, I've only invested in Denver because of that thesis I just told you about. I'm making a long-term bet on appreciation at Denver, Colorado. I think people can live anywhere they want in the world these days and do a lot of jobs, and they choose to live in Denver for the access to the mountains, the great city that we've got here, beautiful weather and sunshine, and the 4 major sports teams. Great, just overall, like there's a lot of things to like about living out here. Mountain view out our window. So I think that's fundamentally my long term bet, and I can de-risk the portfolio to a substantial degree as I'm operating it. I can go to a property, change the locks, and paint if I need to. If times get tough,
Right.
I can move on from my property manager and self manage the portfolio. I think those are huge advantages that I'd be throwing away if I invested out of state.
Yeah.
But if I was going to go out of state, I'd be going in 2024, and I was looking for cash flow, for example, specifically, I might be going to upstate New York, or one of those Midwestern cities like Cleveland.
Yeah, I saw a list just last night about, the top markets, and I think Buffalo was number one. Cincinnati,
Mhm.
Columbus, and Cleveland were all top 10, I believe. So it's interesting to me, but I totally agree with you. Just staying hyper focused on the market where you live, so you have that control over over your asset. I can't
Yeah.
imagine investing out of state, honestly.
Yeah, I think that if you're going to invest at a state, it's got to be for cash flow. It's got to be in a place that you believe is long term appreciation prospects. And like a good reason to invest out of state is, hey, I live in San Francisco
Right.
and I
Oh,
make $120,000 a year,
right.
and it's never going to happen
Right.
here, right? It's going to take me 7 years to do that, and I'm unwilling to move to
Hmm.
these other locations. So I think there's good reasons to do that. But
Yeah.
I think that if you're anywhere but maybe, pockets of California where it's totally unattainable, maybe New York City,
Hmm.
maybe a select number of other cities, it's good to bias towards your local market if you believe in the long-term thesis for that local market because of those risk mitigation factors that I just went through. I think it drives returns over time. Everybody has problems in this business.
Yeah.
And if you can self-manage and operate your way out of them, you're not going to enjoy doing it, but you're going to, I think thank yourself that it was, within a half an hour drive of your home.
So you followed this steady, maybe unsexy path. I think I've heard you describe it as unsexy, but it's works, right? This path with real estate towards financial independence. Looking back on your journey, is there anything you would have done differently?
I mean, I watched dozens or hundreds of people race past me from a real estate perspective, just buy tons of property in the late 20 teens,
Yeah.
and create huge amounts of wealth. So like obviously, in hindsight, 2020, maybe there's some different bets you'd make.
Mhm.
But one of the things I found is that many of those same folks never stop. Right, once you start doubling the penny, it gets very addictive.
Yes.
And a lot of those folks are the ones who transitioned into fund management and capital raising and bought tons of apartment complexes, hundreds of millions, tens of millions of property, and they are screwed
Mhm.
right now. Right? They're at risk of losing all of their investor capital in many of these cases, or losing capital. And there's nothing they can do you can run an apartment complex perfectly in Austin, Texas, right? You can have your marketing dialed in, your operations dialed in. Your asset value is just worth 40% less than it was 2 years ago because the market's crushing you between interest rates and the new supply coming on the market.
Mhm.
And so I think that what I am proud of, or what I'm confident in with my approach, is this concept of a strong financial position,
Mhm.
slow and steady. you know, 20% returns are great, but they're not great if you compound at 20% and then go bust with $100 million. I'll take my 12% or whatever it is that I'm getting on my portfolio. I should probably go back and compute it and appraise everything here to understand that, but at a lower rate, and likely be able to compound it forever without any material risk of a BK bankruptcy BK. So.
You kind of froze up on me there. I don't know. I kind of missed the last part of that, but
Oh, I said, I'll take my approach of investing at a slow compounding rate and avoid, but with a close to 100%, um, uh, an exceptionally low risk of having a bankruptcy or BK event. So,
yeah, I know you're a fan of Warren Buffett, and he's got that one quote. It's like rule number one is never lose money. Rule number two is never forget rule number one. And
mhm.
and to your point, you also another idea of Buffett is buying below intrinsic value. Do you see coming up like opportunities in any real estate asset class where there'll be opportunities to buy below asset or replacement cost? Because it's been tough to do that recently.
Yeah, so I think that in 2024, as all of this inventory comes online, especially in the multifamily space, you're going to see something really interesting opening up, and I think that's where people are going to start trading in effect. Um, and one person's pain is another person's gain, right? So I think that there's going to be, I I think there's a risk of cap rates going from prime multifamily cap rates going from 5% where they are now to 7 or 8%. That would be a enormous destruction in value. But at that point, now you're getting a 7 or 8% cash on cash return from a high quality multifamily asset. I think that's a very realistic possibility. I'm not saying it will happen, but I wouldn't I'm not betting against it at this point in time in 2024. And I think that could be a possibility at the end of the year.
You had mentioned a little bit about your portfolio, and it sounded like you do some index fund investing. I mentioned I did this interview last week, and this guy mentioned the 401k. Another idea that he had was he didn't want to do any index fund investing at all because he felt he had much more control in real estate, much more control over his ultimate returns than he ever would with investing passively in an index fund. Can you kind of share some of your thoughts about that?
I think that's a great question. So I approach personal finance. I think there are two conflicting but simultaneously true philosophies about building wealth. One is that you need a formula to get to financial freedom, and the other is that you need to seize opportunity when it smacks you in the face. And those are at odds, right? We'll discuss this, with couples, for example, and one individual in the couple will be like, "No, we need to put all the money in cash and throw it into the business," and the other will be like, "We need to be investing in the 401k and stock market." And I think they're both right. And I think that's what, how I've approached my personal financial situation is there's the foundation and the consistent formula that moves me towards financial freedom, where every month I'm putting more into index funds. I'm putting more into my savings that are going into the next rental property. And I'm consistently applying that formula that I know has a very high probability of getting me to my end state over the next couple of years. And there are opportunities that you need to seize in life and go after with your time and resources, right? Like the jumping ship from my corporate job to BiggerPockets, for example, right? Like a real estate opportunity, right? That comes up in life. That's an all-in bet for that very first one, like my first duplex was. So I think that I completely agree with him. However, for me, I need both. I need to feel like I have a formulaic approach that will get me there no matter what, and that I'm taking a couple of quality shots that can move me towards my goal. When I was early in my journey, we didn't talk about this. Every quarter, every 90 days, I was trying to take a new shot, if you will, right? There was the house hack. I tried to start a winter gloves for driving e-commerce business.
Oh yeah.
I thought about winter tire rentals as a theme here for the none of them worked. I drove for Uber. I was a tutor, right? And wanted to get into that so I could start a tutoring company for that. So none of those things worked, but they didn't require large amounts of dollars for me to test out from an ideation standpoint. So I agree with what he's saying and feel that there's a formula that many people, myself as part of that, need.
Yeah. Yeah, that makes sense. Is there anything outside of real estate and index funds that you also are investing in?
Oh, my biggest investment is BiggerPockets, right? The company I lead. So I invest significantly in it and am a big participant and feel very strongly about its success as a company. So that's a huge position in my portfolio where most of, I would say, the risk is one private company, right? That I feel really, really passionately and strongly about.
Yeah.
So, and then on top of that, I also invest in hard money notes. So as a rental property investor, some people, a hard money note is when someone is going to fix and flip a property, they will borrow at a high interest rate, usually 10 to 14% interest, depending on how much cash they put into the deal. And then they will fix up the property. They'll complete the project as fast, or they'll either new build or fix and flip or do a major remodel or somehow otherwise stabilize and transform the asset. After they transform the asset, they'll sell it or refinance it and pay back the loan. So these are short-term loans, kind of 6 months to 2 years, typical time horizon, high interest rate. And I like them because I feel like, hey, if I'm going to lend to somebody, let's say they're doing a $400,000 fix and flip a property. They're buying a property for 400 grand, going to put 100 into it and fix and flip it. Well, if I can lend on that, and the worst case scenario plays out, I can foreclose and finish the deal myself, place a tenant, and now I own a property for 20 to 30% off, if you will, from the purchase price.
Yeah, that makes a lot of sense.
I like that a lot, and that produces a lot of simple interest yield, which is very freeing. So I have a couple of those notes and plan to continue to expand that position.
Now, are
Where's
these like towards friends that are in the business or people that you've just met through your Bigger Pockets contacts, or where's your network come, or how do you do the underwriting for these loans?
So there's a industry called hard money lending, and
Right.
hard money lenders typically have funds. So they'll borrow from an institution 30, or raise capital from investors like myself. And they'll raise 30, $40 million, maybe have a line of credit with a bank for another $10 million. And then they will lend out those funds in the, to various borrowers. So if you have a $50 million fund and you're lending out $500,000 hard money notes, that's 100 loans. If you want to do more than 100 loans, you have to sell some of those loans or let them mature. And so they offer the hard money lenders, because they get points, they make 1 or 2% profit each time they originate a note. They're very anxious to do as much volume as possible. So you got to be careful, because you want to make sure you're not buying the notes that they don't want on their balance sheet
Right.
at that point. And you got to do your due diligence. But I like doing that, because hard money lenders that have an established reputation and a portfolio of loans typically have a process for doing due diligence. They'll send me 1099s, handle all of the payments and those types of things, give me rights to foreclose directly if I don't like working with them. And so I shop with hard money lenders available through the BiggerPockets platform.
Nice. So you've got a pretty diversified portfolio with all this stuff that you've got going on. I wanted to hear a little bit more about your CEO of BiggerPockets. I wanted to hear what your average day is like running the company, managing your own portfolio. You've got a young kid right now. How do you manage all that, and what are your days looking like lately?
Yeah. So, I plan, I'm a big planner and goal setter. My
Mhm.
wife and I sit down once a quarter and go through our vision. We update it, and tweak it. Doesn't move quite as much anymore, but it used to move a lot. Well, we think we want this. We think we want this. We kind of have settled in that provides a lot of clarity for those. I then have a set of goals that I want to do for the year, and a set of goals that I want to do for each quarter. I translate that into a weekly planning session on Sunday evenings with my wife, where I say, here are the big three areas that I want to move forward, and here are the things that I want to do this week to get those things done. There's a whirlwind that goes on at work every week that can blow you completely off course. But this simple ritual of just setting once a week, getting back on track, has been very, very powerful for me, because most weeks I'm able to get most of the things that I set as the priorities done, or at least advanced. Sometimes it's literally this one email. Got to send this email to this person to begin this series of events cascading. I get that done on Sunday nights, and that helps. So what does my day to day look like from there? Well, Mondays I usually leave free to focus on the big quarterly priorities that are coming up that particular quarter. Tuesdays is when I typically record podcasts and create content. Wednesdays I typically do my one-on-ones. Thursday is a catch-all for like internal operating reviews, board meetings, or whatever else that I got to do as a CEO. I have a lot of 30-minute calls with various folks, whether they're sponsors or new potential partners or customers or whatever. I try to meet a customer once a week for coffee, and just kind of, hey, what's your real estate journey? How we doing? What do you like? What do you don't like? Give me the goods on Bigger Pockets. I like to do that over coffee and beer. I find you get really good information after 3 beers with a lot of people. Um, and then Friday, I have a one-on-one with my boss, our chairman, an operating partner, and we have more kind of catch-all time. I also get a lot of content done. So that's my typical week now. But in Q2, that will completely change, because I like to reset my calendar every quarter to make sure I'm focusing on the most important stuff.
How was that transition? Well, I don't know if I want to go into this. I'm curious about the transition, like taking over for Josh, but I don't know that if we need to record that maybe
You can
afterwards.
ask whatever you like. Yeah.
So yeah, okay, well we'll get that edited out. We do a ton of editing on these. So, but yeah, I wanted to hear about like the transition when Josh and Brandon left Bigger Pockets. What was that like for you taking over and filling their footsteps, filling their shoes rather?
Yeah, so it's been interesting. When Josh stepped away in late 2017, and I was you know you know by the other people in the company, I was actually elected as acting CEO at that point. That was really interesting dynamic, because Josh had to step away from personal reasons, We
Yeah.
didn't really have a formal succession plan. I didn't have the ability to fire, promote, change compensation for these folks, but for a period of months, we operated the business and we're able to drive things forward.
And it
In
was a
2018,
democratic election in a sense, like everybody at Bigger Pockets, like had a vote on who should run the company?
among the small leadership team at that
Okay.
point.
Got it.
So it was not a company-wide election, if you will, but that
Okay.
was interesting. And a few months later, Josh named me president, and I had those powers officially.
Mhm.
I reorganized the business at that point in time, and some folks didn't like that reorganization.
Sure.
But I was like, hey, if I'm going to be running things, I'm going to make sure I know what everyone does, and I know why that function exists. And I couldn't have said that for, 5 or 6 different roles. And so some of those people loved the new role and thrived in the new position. And some said, nope, I'm out. And we actually called that the bigger apocalypse at the time. That was very challenging for me because there was some turnover because people didn't like the changes I was making in those
Right.
first couple months. 2018 ended up being a fantastic year for us. And we recapitalized with a private equity group out of Omaha, Nebraska called McCarthy Capital. And they brought in a chairman of the board who was kind of my boss,
Mhm.
and he was a mentor, tough, coach. Hey, here's what world class looks like, and you're not it right now with these
Right.
things. In a
Yeah.
he never said it like that, but I knew I was like, oh boy, I've
Yeah.
only had my experience. I haven't had the experience of working with 20 other CEOs and you know 50 different chief financial officers and whatever. And so over the next 5 years, we developed a strategy for Bigger Pockets. We understood our market much more clearly. We put together a leadership team. I learned what good and bad looks like from various leadership team positions. And I went through the pain involved in reorganizing the business and putting those roles together. And we grew the company over that period of time as well. Brandon was instrumental, of course, to BiggerPockets growth for a very long period of time.
Yeah.
He left at the end of 2021, I believe,
Mhm.
to pursue his new fund, Open Door Capital, and build his nonprofit, the A Better Life Tribe. So it's been fun watching those businesses grow. But that was a really big challenge for us because at the time he was our podcast host. A lot of people followed him personally, and there was questions like, is what how
Mhm.
important is Brandon to Bigger Pockets with that? And while I'm super thrilled for all his success there, I also feel like it was really important that he did leave when he did, so that
Yeah.
Bigger Pockets could move on to the next chapter. And I think today we are thriving. We're as strong as ever as a company, and have a ton of different hosts, talent, authors, representing a variety of different viewpoints. And I think we've really shown that what I think the beauty of Bigger Pockets is it's not about my views on real estate, right?
Mhm.
10 of our other hosts will disagree violently with what I just said about the
Right.
markets and all those kinds of things. It's the community and crowdsourced feedback of people who try their best, think they know what they're doing, and disagree and debate each other and know that they're probably going to be wrong on a variety of different things, and that there's always new strategies popping up.
Yeah, the community's huge. I mean, that was such an important part for me in my learning early on when I had a pro membership and just being able to bounce ideas off of people. It's just like invaluable.
Absolutely. I think that's the power of it is it's not one man's secret sauce to real estate investing because there's no such thing.
No.
It's the crowdsourced wisdom of the community and the new tactics that are constantly popping up to make money.
Yeah. Before we wrap up, I wanted to do a quick fire round if we could. So I wanted to hear what your most controversial or contrarian take on real estate is.
I think it's the risk of a 30+% additional cratering in multifamily asset values in 2024. Large
How?
apartment complexes, I think, are one of the most at-risk asset classes in this country right now.
Right. Right. What are you currently reading? I see a bunch of books behind you. I wanted to hear what you're currently reading.
I'm currently reading Number Go Up about the crypto boom and bust.
And what's your takeaway so far?
Uh,
Is it
my
Bitcoin specific or is it the whole, the whole arena of crypto?
I was not a fan of crypto. I've tried to read both sides of the argument.
Mhm.
I think that the side that is most rational to me from for crypto fans is the one espoused by Saifedean Ammous from Bitcoin Standard, and they're Bitcoin maximalists. If you're going
100%.
to bet on crypto, to me it makes
Yeah.
sense that Bitcoin specifically would be the winner. That would be your, hard money. That would hard currency that would potentially replace fiat currency long term. All of the other cryptos have never made sense to me. This book confirms, I think, that skepticism, and I think exposes the wild west of just how many scams and absurdities were going on just a few years ago in that space.
Yeah, that was a game changer for me too. Reading the Bitcoin Standard by Saifedean, I had a bunch of different, quote unquote crypto speculations, and after reading that, I stuck strictly to Bitcoin. It's like there's going to be a winner take all, and uh, there might be some use cases for a couple others, but in general, there's going to be a winner take all, and it's pretty clear, I think, what that winner will be.
Yeah. Like the main thesis, and I haven't finished the book, so we'll see how it ends. I probably should know this, but is around how, a lot of these coins, or a lot of these coins claim to be stable coins
Right,
and were backed by US dollars, but then they weren't actually backed by US dollars. So
right.
once something that's supposed to be worth $1 is worth even 98 cents, the
Oh,
whole thing collapses, because
absolutely.
why would you be the last
Yeah,
two people
yeah.
out of 100 to leave your money into it and not get your money back? So
Yeah. The unfortunate thing I think is like there's so much of the crypto stuff that's conflated with Bitcoin that that's a whole nother topic and a whole nother rabbit hole.
yeah, and we're way over. You could edit this out or whatever, but the reason I don't invest in Bitcoin, even if I think that the Bitcoin maximalist approach is the most reasonable take on crypto overall, is because at the end of the day, crypto or Bitcoin would be a currency. What would I use the currency to purchase? I'd use the currency to purchase things that I want for my lifestyle, or assets that produce income and are likely to appreciate in real value, like real estate. So I'm just like, I can invest in Bitcoin, or I can purchase rental properties. And which one is the better bet long term? We'll see. There's a case where Bitcoin takes over the entire world economy and becomes worth, all the value of all of the cash in the world, and goes up soaring in value. But even at that end state, I would then use Bitcoin to purchase rental properties,
Right, right.
and receive payments in what, satoshis, or whatever. So I think that ends up being my how I've kind of rationalized this whole world of crypto into, hey, I'm just going to stay out of it, because the goal isn't to have is to have the cash flowing properties at the end state anyways.
Yeah, there's an argument that's made that there's a lot of monetary premium that's in real estate that Bitcoin will, whether who knows what percent, but it will suck some of that monetary premium up. But yeah, it's hard to know. Like time will tell for sure. But I don't know. We all have to make our bets, and it's a risk
Absolutely.
no matter what you do. But like you said, there is no right answer for everybody.
Absolutely.
Scott, this was a lot of fun. I really appreciate your time. Do you have another book in you? Is there anything coming out that we can look forward to?
I'm not personally working on a book right now. My kind of passion project, if you will, is something for bigger pockets we're calling passive pockets.
Huh.
So because so many of these, because we're seeing this pain in the commercial real estate space, and a lot of folks have put together syndications
Mhm.
um, in the space to raising capital. I think a lot of investors didn't really know what folks charge for fees, or what they, what the business models look like, or how to underwrite them, or the risks inherent in the commercial real estate world. And so we want to really put together a product to educate folks on how to think about those passive investments. We really focused on the single family, small multifamily duplexes that people personally own and operate, and
Mhm.
not as much on these larger funds and passive investments. So that's what we're working on. I don't know if a book will come out of it, but it'll certainly be a lot of content.
Passive pockets. Cool. I'll have to check that out. So for people that want to find out more about you, find out more about bigger pockets, just what you guys are up to, what's the best way for them to do that?
You can just find me on BiggerPockets. Post in the forums and tag me. You just type in the @ symbol and Scott Trench, and I'll come up. You can ask a question there, and I'm happy to respond and engage all day.
Cool. Scott, thanks so much. I really appreciate your time. This has been fun.
Thank you, Patrick. This is great.
But I found that there is not a resource for people to look at themselves and look at their own life and say, these are my personal values. This is my risk tolerance. These are the resources that I can bring to bear. And how do I go from where I am today and achieve whatever my financial goal is using real estate. And there wasn't really a way to create that roadmap. And so that's where the idea came from.